in 27 or 28, what percentage of the cars sold in the U.S., not just battery charged hybrids and gas engines, do you think will be set up to have autonomous driving?
Well, it'll probably be however many Tesla can make. Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
We start on Exhibit C, which has been modified to assume sanctions on Russia and Iran so that the surplus of oil goes away. Now, this version of Exhibit C may only last for a week or two because maybe, especially with Russian delegation and U.S. delegation sitting down in Riyadh, maybe there'll be movement on Ukraine. Maybe the Iranians will come to their sense and negotiate with the U.S. to lift sanctions. But if neither of those happens, the surplus of oil supply rises up. You can see it gets down to 1,200,000 barrels. Saudi Arabia producing 9.5. Now, if you read articles, they're going to say it's not 1 million, it's 3 million. But that's based on Saudi Arabia being able to produce 12. But they never produced 12, and it's not clear that they could. So now that takes Russian production down to 9.4 from 10, which is 600. I mean, we can easily run sanctions to get more decline than that. And that takes Iran from 3 down to 2.2. So we stick with a wide range. I mean, if Russia gets sanctions lifted because of a deal with Ukraine, and Iran gets sanctions lifted in return for not running their centrifuges to make enriched uranium, we could have $50 oil. If the sanctions are tougher than in this 25 estimate, we could have $80 oil. Huge amount of volatility. Turn to Exhibit B on gas, moved U.S. production up a bit. I mean, dry gas production is running at 105 now, so it should increase during the year. Also, it moved Canadian imports up a little. Did move residential commercial up a bit because of the marvelous winter. Residential commercial's been running 24.3, 24.7, have it up at 25.5, and that's the impact of the winter. The LNG feed gas is pretty solid at 14.5. That's Blackmans is on at 1.5, and the third facility at Corpus is on at like 1. So 14.5 looks pretty solid. We're going to talk data centers later. You have gas demand for making power up by 7 Bs over the last 5 years, which is remarkable. I mean, LNG has gone up like 4 during that time period. The question is, will the pattern change from what it's been, which is 1.5 Bs per day per year? And we'll, as I say, we'll get into that later when we talk about data centers. Exhibit A, the position by Musk, and I think by the administration, certainly by the Treasury Secretary, is that spending has to come down by somewhere between $600 billion and $1 trillion. The Treasury Secretary is $600 billion, Musk is $1 trillion. That has to come from all other, which was $1.4 trillion last year. A couple $100 billion has to come from that. Interest we're stuck with. I think Social Security and Medicare are just going to chug along. think the other place it has to come from is Medicaid, which is a federal commitment of funds for state Medicaid programs. Could they get defense down a bit? Defense has been running, it's supposed to run $900 billion. I suppose if they really took the Doge approach to defense, they might save $100 billion there. But I think it's the case that even though we're the world's reserve currency, this is something that has to happen. The revenue line in the 5 trillion range, I don't think removing tax on tips, continuing. Remember, the tax cuts they're negotiating is just a continuation of what's on the books. I think we'll continue to do 5 trillion. I actually think in 25, given the way the economy's going, we'll do more than 5 trillion. So maybe you pick up 100 to 150 there. Mike or Jason, anything to add on that take on Exhibit A?
No, I don't think so. I mean, we keep seeing some of these cuts coming out of Doge, but actually Jason brought something up that was I wasn't aware of. The government employees that have been laid off were probationary employees.
Right. Yeah, because you can't, I don't believe you can just cut employment of a federal employee, but while they're in a probationary period, you can terminate the employment. And that appears to be what the White House is doing, is terminating the employment of all probationary employees. So even though you see numbers in the tens of thousands, they were all people that were hired within the last 6 to 12 months. I've seen conflicting reports that if you change roles, if you were hired into a different position, that counts to put you in a probationary period, but that kind of didn't really make sense, at least in corporate world that doesn't. So, not sure.
So I think the point is that we're still at the beginning. We'll see, we'll see what the impact of some of this stuff is. It'll take longer to play out.
Right. But as of right now, we're rolling back to the size of the government in 2023.
Yeah, the Treasury Secretary, I think we mentioned this last Wednesday, the Treasury Secretary has come up with a really good idea. And let's focus on the 10-year rate rather than what the Fed is doing. And that should respond to cuts in spending. And maybe the 10-year rate is a better target than what the Fed funds does with what the Federal Reserve does with the Fed funds rate. So with that, I think page 1, which is these large cap companies, are all updated for their 10Ks and stock prices. And page 2 is still pretty much 9 months. Page 3, still pretty much 9 months. We'll get to that. But there's news on all 3 pages that we'll try to cover, leaving at least 5 or 10 minutes, something more than 5 minutes at the end for healthcare. And on page 1, I'd like to focus in on Tesla. To me, and I'll see whether Mike and Jason, what commentary they have, seems to me, looking at the world now, as it's going to work through this year, into next year, and into 2027, the 2 most interesting companies, forget what they're selling for, the 2 most interesting companies are Tesla and NVIDIA. And this is not to say that to exclude everyone else, but everyone else is pretty well established. Now, Tesla, is dependent. I mean, it's a very strong balance sheet. It's got $36 billion of cash on hand. They only have $6 billion of debt. They do have free cash flow. Their free cash flow at the run rate last year is $2 billion rather than $4 billion. The business is trading for, over $1 trillion. It's a heck of a multiple times 2 trillion of free cash flow. But they have autonomous driving coming. And in NVIDIA's case, they had their gap up. And the question is that sustainable? I mean, their run rate based on last quarter is around 130 billion, producing 70 billion of free cash flow. But, now they trade for 3 trillion. And that's 40 times free cash flow. And is that sustainable? And Mike and Jason, I don't know who wants to pick NVIDIA and who wants to pick Tesla. I'd love to draw you both out on whether or not you agree with that assessment of, in this first 4 pages, those, forget valuation, those are the 2 most interesting potential gaps up. And while a gap up in NVIDIA seems like, trees don't grow to the sky, how can that possibly happen? Look at the capital budgets for Amazon, for Alphabet, for Microsoft, for Meta. I mean, they're all going up 30%. And some significant part of that capital budget finds its way into NVIDIA equipment. Why don't we do NVIDIA first? What's the case for them doing in the next 12 months, 200 billion of sales, up from their run rate of 120, and preserving their profit margins? So rather than doing 70 billion of free cash flow, they do, 120 billion of free cash flow. Is that wishful thinking or moving into a bubble, or what are we talking about here, do you think?
So I'll take that one because I've run through the math on it. And if you look at their top handful of customers, the hyperscalers and Meta, NVIDIA, those companies are going to spend 300 to some reports as much as $320 billion in CapEx. Yes, for 2025, right? So if you assume conservatively, 60% of it is going to go to data center. And then of the data center spend, about 50% goes to NVIDIA. That's a relatively conservative estimate where you can, and then you make the assumption that similar to in previous years and quarters, that group of customers makes up about 50% of their revenue, of the data center revenue. You quickly get to a number of, call it $180 to $200 billion in top line revenue for NVIDIA. So I guess all that is to say is, yes, you could see a pretty substantial, and there's nothing that we're seeing, in the tea leaves and the news and the changes in the way people are allocating capital that would suggest anything other than that maybe is an underestimate. The latest news out of XAI, for example, is that their next cluster is going to be 1 million GPUs, 1 million H100 equivalents, if you will. And that's up from the 200,000 that they have operating today. So that's another player that's not even counted in those top customer metrics. So, and then you have news out of Korea that Korea is going to have a huge AI data center project as well. So you have many things pointing in the right direction. I think we've had some really cool algorithmic improvements that'll improve the efficiency and get the costs down. And the thing to recognize is that as cost goes down for the ability to inference some of these projects, the use will go up as well. So we're still pretty confident in NVIDIA's outlook and think that from a valuation perspective, it's pretty fair.
Yeah, I think long term, we think these AI inferencing models will be a part of every software product that we use. And if that's the case, we're really in the early stages of building out the inference infrastructure to do that. Only the hyperscalers are doing it. And eventually there has to be a build out that's sustainable for hosting all of the apps that aren't, a Google or an Apple Intelligence. So every other software developer is going to need some infrastructure to inference their models that they build for their applications. We haven't really seen that being built. And I think that becomes more of the edge compute that you hear people starting to discuss. And DeepSeek really highlighted how it's possible that edge compute really can be the inferencing infrastructure. If you can push it down to a single GPU to host your model, you can host them much closer to the end user. I mean, a couple weeks ago, we were talking about how Netflix hosts videos in every city so that the streaming can happen with very low latency to your house. The same thing will occur with all of these AI models. There'll be a copy of the model in edge data centers that are located in every city in the U.S.
Meta, we'll get to Tesla in a second, but Meta this week said that they were going to put in a bunch of fiber, like 30,000 miles of fiber. And the Earth's circumference is only 35,000 miles. It seems to me that's a positive for NVIDIA, because I don't see how they can make a decision like that unless they're going to continue to put together lots and lots of GPUs.
Yeah, that's a good point. I mean, Meta has been more committed to the NVIDIA ecosystem than most, more explicitly committed. There are some bottlenecks, I think. I mean, I'm not an expert in the architecture of the internet, but there are bottlenecks associated with the current infrastructure, and that data centers are getting concentrated in a handful of places. It's just hard to add more of everything in the same place. So increasing the backbone, if you will, should be a net positive.
Yeah, there's a couple interesting things about it. One is the route that it takes around the world. So it essentially starts on if you think of one end as the east coast of the United States, it goes around the world and ends up on the west coast. It avoids, Meta said they avoid hot spots in the world. They avoid like the South China Sea, and they don't go near Russia. So they're looking for, avoiding potential cuts in the pipes that run the internet, which have occurred, kind of similar to how we saw the gas pipeline cut in the North Sea. So they're avoiding hotspots, but really, if you look at it, it's going to and from India. So some of the speculation is they're going to be building a lot of data center infrastructure in India, and then serving the world from there.
Interesting. Jason, you're the Tesla expert. If it's easy, if Tesla were $100 stock, that would really represent great value.
We'd like that.
Yeah. So suspending for a while the discussion of Tesla value, what do you think let's put it another way, how likely is Tesla's free cash flow to be $10 billion sometime in the next 3 years? And one thing that showed up in the 10K is utility scale batteries. The facility that we're aware of, because one of our companies provides all the gas turbines in Memphis, let's say they have 500 megawatts of gas turbines. They have 200 megawatts of utility scale batteries, all made by Tesla, because the load goes from like 300 to 600, and they just keep all the turbines spinning when it's 300. And they just load the batteries up. So the batteries aren't there as a failsafe and keep in case they shut off with gas. They're there to handle the up and down in the load. And I assume the up and down in the load is not just language models, but it'll be inference, compute, just because they're 24 hours a day, and the capability of that service you're providing to all of us will vary. Is that a fair way to look at it?
Yeah. Internet usage can be spiky, but if you think about internet usage overall, it's kind of it levels itself out. examples like Ticketmaster will put tickets on sale at 10 a.m. Everyone's going to the site then, so usage spikes. But overall, the internet, everyone's usage flattens it out. I'd love your thoughts on grid scale batteries. I'm a little skeptical. So in California, we've had in the last year several instances of grid scale battery facilities burning to the ground. And our largest facility burned down by coincidence. It wasn't in LA, but the same week that the LA fires are going on. So it overshadowed that fire. But it was a facility that I believe wasn't even 5 years old. One of the batteries catches fire, and then the fire, you can't put it out. So it spread the whole facility, burned the whole thing down. If the lifespan of these facilities isn't that large, isn't that long, how does it justify the expense of it? And maybe the technology is improving there. It should be, but it's hard to beat pumping water uphill, I believe.
Well, that's right. If you have that kind of facility around, I have to say, and this is a bit of a diversion, that a lot of the batteries in place, utility scale batteries, are CATL or BYD. I don't mean to say that Chinese manufactured batteries are more likely to burn, but what we see in the utility scales that Tesla's making them here probably have the same potential to run away and burn. But everyone is paying 10 or 15% more to Tesla because of the warranty, because of the help in setting them up. And I suspect that these batteries, utility scale batteries, can be arrayed and installed in a way that substantially reduces the fire risk.
That makes sense. Yeah.
Autonomous driving. If Tesla got to $10 billion of free cash flow, and let's give it another couple of years, let's say it's not 27, let's say it's 28, would half of that come from the cash flow from providing autonomous driving on top of selling people Teslas, do you think?
That's a good question. If a car drives itself, its value goes up dramatically. You're not just buying a car, you're buying a driver for years, or they provide it as a subscription service. So if it's a subscription, that'll be a very high margin item.
Well, my thought is Tesla's going after a very clear scale economies play in automotive manufacturing. So they're getting the cost of manufacturing the vehicle down as low as possible. So much that you can lease a Tesla Model 3 right now for $250 a month, which still blows my mind. Now, once you get that Model 3, you can pay an extra $8,000 for the autopilot software. I think that's where they're capturing their margin, because you have zero marginal cost on the software. So they're happy to sell the hardware, the computer, the car, the computer, as at break even or relatively thin margins, because it essentially squeezes everybody else out.
And if you look at if you believe the world is going to be self-driving vehicles in the future, and if no one can compete building an electric vehicle with Tesla in the US, and then no one but Waymo can compete with autonomous vehicles, and they don't manufacture the vehicles. So where does the competition come from? Do they just own this market?
We've got one more question, and then we have to switch to healthcare, and we will do more on Tesla and NVIDIA, especially after we get the NVIDIA results for their fiscal year ends in January. I have another question, which is kind of provocative, I guess. In 27 or 28, what percentage of the cars sold in the U.S., not just battery cars, hybrids, and gas engines, do you think will be set up to have autonomous driving?
Well, I guess, and by autonomous driving, I assume you mean like level 5.
Yes.
Which is full, no steering wheel, fully autonomous.
Yeah.
Well, how many cars are sold in the U.S. a year? Is it 11, 15 million? Yeah, 12.
Yeah, 15 million cars and light trucks.
Well, it'll probably be however many Tesla can make.
Well, no, but the question, let me pose the question another way. Will autonomous driving be so attractive that Ford, GM, Toyota, everyone else delivering cars in this country are going to have to put into the car the capability to be self-driving using the Tesla system?
Yes, because I think it'll be table stakes. I think at some point it flips to where your usage of the car and the insurance that you pay will go down dramatically when you use a full self-driving product, and your insurance will skyrocket for cars that do not have the full self-driving product.
I agree, but I think it might take longer. Human behavior takes a long time to change, and then once a GM realizes that they have to do this, their production cycles are measured in half a decade. So they'll have to design it out and put it in the roadmap, and they might be in the 2030s before it shows up in a GM vehicle. Yeah,
and the challenge for General Motors and Ford, all these guys, is if Tesla's out commoditizing the hardware, commoditizing the car, and making money on the software, how are they going to? I mean, how are they possibly going to have the capital to invest if they could even get the right talent to be able to do a competitive product? And that's where this thing boils down to a kind of a winner-take-all market, potentially.
And we only have a few minutes left. We'll do more of this next week, but how about healthcare news, Jason and Mike? With what is Vertex Pharmaceutical or Harrow or BioNTech or
RFK Jr.?
Yeah.
RFK Jr. Yeah. It's now
do you want
confirmed.
to do the executive order?
Go ahead.
So the Make America Healthy Again executive order was put out last week, or was it over the weekend? Either way, I thought it was super encouraging because the way I looked at the rising cost of healthcare in the U.S. is, I believe, very similar to how RFK Jr. looks at it. It's a little bit self-inflicted. We are making ourselves sicker by the decisions we make with our food supply. That causes more demand on the healthcare system. We hear about the understaffed, the healthcare system stressed, supply and demand. So we're demanding more healthcare services. The cost goes up. And really, the executive order kind of took aim at let's. The gist of it was, let's investigate why we are less healthy than the rest of the world. So that's great. Like that's exactly what we should be doing. We shouldn't be figuring out how to adjust insurance or the price of individual drugs. Like, we need to figure out why we are sicker.
Yeah, a root cause analysis is certainly warranted at this stage.
And a lot of it was dedicated to looking at the disease rate in children. They're the future. Why are they even sicker now than?
What's the stat you gave me today about the percentage of young people with a liver?
Yeah, it was 18% of, 18-year-olds have fatty liver disease, which I think it was rare across the whole population not very long ago. So really encouraging to see that, even though, they get a bad rap on a lot of what they're doing. But this is exactly what we need to do. We need to take a look at our food supply and, what are the effects of microplastics and pesticides and ultra-processed foods, and is that the root cause of why we need more healthcare services? One interesting thing in the executive order is it was kind of out of the blue in there, and it was to look at the impact of SSRIs. So that was interesting. And the use of those has gone up dramatically among the youth population. And they have a lot of long-term side effects. So we have a lot of thoughts around that one specifically, and also a good thing to include in there. But it was interesting that it was just kind of out of the blue, stuck in the executive order.
Yeah. I mean, the takeaway here is there's a lot of, for those that are interested in health research, there's a lot of positive trends that you can extrapolate from what the new administration is saying about how we're going to research health. And one of the biggest problems with healthcare research is that data is siloed in 3 different buckets, right? You have the payers, you have providers, and you have the drug companies. And none of those groups necessarily talk to each other. And it prevents you from doing really effective population health analytics that would otherwise be relatively trivial if that data were made available. So I think pretty clearly there is some intent to open up that data. And of course, you'll have to do it on a de-identified basis to make sure that you protect people's privacy. But all of this is easy to solve. It's just hard. Basically, you have to coerce each of these providers, the payers, and the pharma companies. You got to coerce everybody into sharing it in one common place. So it'll be interesting to see how that takes form. But it's really the example of the perfect type of government intervention where you have the market is not solving the problem. So if the government is going to intervene and require something, it better be to solve something that a market-based solution is not willing to solve itself.
Yeah. Well, Doge has until July 4th, 2026 to get after it. At the pace they're going, I should think we might see it by Easter. What disease is the SSRI prescribed for, Jason?
They're antidepressants.
Yeah.
Yeah, but they have long-term side effects, and some of them are even, I don't know if they're permanent, but they last much longer than your use of the drug.
Are there any medicines coming that do the same thing, kind of like Vertex Pharmaceutical and pain?
There's others that have been on the market for a long time, and then there's a lot of research more recent around the use of ketamine. So there's a nasal spray that is approved as of a couple months ago, I believe, that Janssen owns. It's a ketamine nasal spray, and then there's a pill form of a similar chemical structure to ketamine. That drug's called volatility from Axsome Therapeutics. So they're all are alternatives.
Mm-hmm. Right. Well, more on that next week, too. In the meantime, everyone be safe and stay healthy, and we'll be here in exactly 7 days. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.